this is me. Okay, I work for myself. I'm what's known as a sole trader. And it may be that I actually don't want to work for myself. I want to work with a business partner. So here's my business partner. And what we do is we agree to work together. We take all of the income that we're going to earn, we pool it together. We deduct any costs we incur, and any money left over we share on an equitable basis. In this case, we're what's known as a partnership. Now, what we could choose to do is to actually set up a separate company. So here's our company that's set up, and we're going to call it the Trading Company Limited, for example. What's the difference between us working as a partnership or as a sole trader and us working for the Trading Company Limited? Well, the clue is in this word here, limited. Limited what? Limited liability. And so this effectively limits the liability of the shareholders. It creates what's known as a veil of incorporation. And a veil of incorporation separates the owners from the business. So if you thought that, I don't know, Enron was a really good investment and you'd invested $10,000 into Enron, when Enron went bust, you'd have lost your $10,000. But what you wouldn't have had is a landlord phoning you up saying, I'm the landlord of Enron, Enron owes me $1 million in rent, Enron's gone bust, you own Enron, and therefore you owe me $1 million in rent. So we're limited to the extent of our investment. And when we think about that, that's a pretty important concept and marks the basis of capitalism. To my knowledge, the concept is relevant in every country in the world. And it allows us to take risks. Because if you think about it, I wouldn't buy a share in an oil company, for example, knowing that not only could I lose my investment, but I could lose my house, my car, my furniture, and all of my possessions if that company goes bust. So this Trading Company Limited, this is a separate legal entity. And if it's a separate legal entity that can enter into contracts in its own right, we therefore need to appoint somebody who's going to run the business for us. Now, in our example, the owners appoint themselves as directors to run the business. So this becomes what's known as an owner-managed business. The owners, the shareholders, appoint the directors to run the Trading Company Limited on behalf of the owners. And the company starts to trade, and as it starts to trade, it starts to grow, and as it starts to grow, we need some more directors to help us run the business. And after a while, it's so successful that the original owners retire from the directorship, and now they are sitting on their super yacht somewhere in the Caribbean. So we now have the owners sitting on their super yacht and the directors who are running the business for the owners. How do we know how those owners, how the directors are performing in running the business? So if I'm an owner and I'm sitting on my yacht, how do I know if the directors are doing a good job or a bad job? Well, each year the board of directors prepare the annual report and accounts, or the statutory accounts, and send these to the owners. Now, if the directors are doing a very good job, the annual report and accounts will say, we're doing a very good job, can I have a big bonus? And if the directors are doing a very bad job, then the annual report and accounts will say, we're doing a very good job, can I have a big bonus? So how do we make sure that they're telling the truth in the statutory accounts? Well, this is where we have the independent auditors, and the auditors are appointed by the owners. So the owners appoint the auditors to check the figures which are prepared by the directors. So this is a form of corporate governance. Now, looking at the board of directors, we might split the board of directors between the executive and the non-executive directors. And what's the difference in their roles? Well, together they form the board of directors. So they'll determine the strategy of the organisation. The executive then execute that strategy. So they have day-to-day responsibility for running the business. The non-executive are there as a critical friend. So they hold the executive to account. Because if you buy a share in Vodafone, for example, you will not have right of access to the boardroom of Vodafone. and therefore you depend on the non-executive to hold the executive to account to make sure that they're running Vodafone in the best interests of you, the shareholder, not in the best interests of the board of directors, the staff, the suppliers, the customers, or any of the other stakeholders. Right, let's look at this business in a little bit more detail. This business is going to have a whole lot of assets. Now think about what types of assets that your company has. If you're working for an organization and you're watching this video at work, you're probably watching it on a laptop or a computer which is owned by the company. So that's an asset of the business. So tables, chairs, computers, plant, machinery, buildings if we own them, although most companies tend to rent their buildings, but anything that the company owns is an asset. Plus things like the stock in the warehouse and cash in the bank is also an asset. This company also has lots of liabilities, and a liability is something we owe to a third party. So perhaps if you've bought a house, you've probably taken out a mortgage to buy your house, and therefore that mortgage will be a big liability. And in exactly the same way, if a company wants to buy some plant and machinery, it may well have borrowed the money to buy that plant and machinery. You may have credit cards or unpaid phone bills or gas bills or water bills. Those are also liabilities for you. And in exactly the same way, a company will have suppliers who supply them with goods and services that they haven't yet paid for. So a liability is anything that's owed to a third party. Now, if we stop trading, if we close the business down, and I'm talking hypothetically here, the first thing we do is we take the assets of a business and we turn them into cash. So we take all of the assets, the tables, the chairs, the computers, the plant, the machinery, and we put it all on eBay, for example, and just sell everything. Once we've sold it and we've got the cash in, the first thing we have to do is to pay off our liabilities. So we pay off the debt, we pay off the suppliers, pay off the staff. Anything left over is known as the net assets. Now this word here, net means something less something else. And in our example here, it's the assets net of or less the liabilities. And those net assets, the money that's left over, we need to give back to the shareholders. And therefore the net assets is equal to the shareholders' funds. That's sometimes referred to as the equity. Now the shareholders' funds, is that an asset or a liability? Well, if you think about it, it's an amount owed by the company to the shareholders, and therefore it's treated as a liability. But it's not like a liability that we've come across before, because the difference is that this first type of liability, this is a compulsory. You have to repay your debts, you have to pay your suppliers, but you don't have to give any money back to the shareholders. It's a voluntary amount. And why don't you have to give any money back to the shareholders? Because your company is what's known as a going concern. And a going concern means that you're trading and expected to continue to trade for the foreseeable future. So, summary. The assets less the liabilities is the shareholders' funds. It equals the net assets, which is the same as the shareholders' funds. The liabilities are owed to third parties. It's a compulsory amount. And the shareholders' funds is like a voluntary liability. We don't have to give the money back to the shareholders because we're trading and we're expected to continue to trade forever. We're a going concern. And this gives rise to what we call the accounting equation. And the accounting equation says that for every business, the assets less the liabilities, which is the net assets, is equal to the shareholders' funds. Is it therefore fair to say that the assets of a business is equal to the shareholders' funds plus the liabilities? Now, some people struggle with this concept. It's really just basic maths when you think about it, though. Because if you have a company with assets of 5 and the liabilities are 3, the net assets or the shareholders' funds are 2, because 5 minus 3 equals 2. And all I've done in the second line is to say that 5 equals 2 plus 3. And therefore the assets less the liabilities less the shareholders' funds equals 0. It's a zero-sum game. And what we're looking at here is the balance sheet. And the balance sheet is called the balance sheet because one side always equals the other. It balances. And this is a fundamental part of accounting. So this shareholders' funds, now the way I've presented it so far is like the bit that's left over, the balancing figure. But we don't work in bits that are left over in the finance world. Everything is specifically accounted for. So what do you think are the two main things a company owes to its shareholders? Well, the first one is any investment by the shareholders. So if you're a shareholder and you invest $100 in a company, the company will say, thank you very much, assets, cash, $100, but I owe you shareholders' funds that $100, and therefore the balance sheet will balance. What does a company do with that $100? Well, hopefully they invest it and they start trading. And if they start trading, they'll make a profit. And whose profit is it? Well, if it's your company, then it's your profit, and the company owes you that profit. But the company doesn't have to pay you that profit. They could do one of two things. They can either pay it out as a dividend, which is a distribution of profits, or they can reinvest it back into the business on your behalf. So for example, if a company makes a $500 profit and it pays you $400 as a dividend, that's $100, it hasn't paid you, it's reinvested on your behalf, it still owes it to you, it's the retained earnings or the retained profits reinvested back into the business. And so there we see the fundamentals, how a company is financially structured. And it's really important, I think, that you understand this, because a lot of the questions and the queries that I come across later on in the module are often solved by reference to this diagram here.